Okay, good morning everyone. If you can remember in our previous session, I took you all through audit planning related standards. That was very much exam focus session. During that we have covered basic planning standards. SLAUS 300, basic audit planning standard, and SLAUS 315, meaning understanding the entity, and risk assessment procedures, SLAUS 330, responding to assess risk, and if I'm not mistaken, audit materiality. So these are the key standards that we have covered during our previous session relating to audit planning. And the recent past paper question relating to audit planning also we went through, right? So today also I'm going to discuss with you very important area of your syllabus and very important question. I would say it's a mandatory question in your paper, which is relating to audit reporting. Why I'm saying this is why I'm telling this as a key part of your study pack or important for your exam, because if you take any auditing paper, CL1 paper, if you take last 5 years papers, it's a mandatory question. There is no auditing paper without audit reporting question. Before we start the session, I can give you an assurance. If you are with me for next 2.5 hours time, I can tell you, let's say if it's 15 or 10 marks question in your paper, you will score maximum of it, right? But I can't guarantee, because that depends on how do you absorb this session. I'll try to make it very simple, and I'll try to cover all the relevant standard for audit reporting during next 2.5 hours time, and we'll focus when we'll do some past paper questions also. Then you can see whether you can manage other past paper and model paper questions. So before we start again the formal session, I mean, when I say formal session, this is also formal, but before we jump into the core areas of the session, this is very much exam focus session. Therefore, within 2.5 hours time, we might not be able to do a detailed session, or we might not be able to cover each and every aspect of each of the standard, right? But what is important for exam, to manage any exam question, what is required to learn will be covered in this session. So that is why this is very important, because we have very limited time to the exam, almost 1 week time, sometimes less than 1 week. Therefore, this is very important. So then what you can do, since you have done so many studies as of now for the upcoming exam, you can see whether you are in line with whatever the things that you have studied so far, or on what areas you need to give more focus. So that assessment, that self-assessment you can do with this session, right? Fine. Okay. Let's start audit reporting. So before I jump into the key areas of the standard, right, let's try to learn some of the key words around this topic, audit reporting. Within next couple of minutes, within 5 minutes time, you can see whether you are familiar with these words. If you are not familiar with these words, it indicates some amount of risk, meaning you are not yet ready to handle audit reporting related questions if you are not familiar with these words. That's why I am taking next 5 minutes time to summarize the entire audit report in chapter into one diagram, one visualization. Let's see. Right, audit reporting. Sorry. Audit reporting. So when we take this topic, right, we can divide this audit reporting topic for easy learning purpose for two categories. One is unmodified opinion, right? Because in an audit report, the main message or main outcome is what? You are giving an opinion, right? Why do we require a report for auditors in auditing? Because it has opinion. So this is the heart of the report, I would say, right? Audit opinion. So one part of this chapter is relating to unmodified opinion. So then obviously the other side is what? Modified opinion. Modified opinion. Unmodified opinion and modified opinion. So don't worry, my writings are not that perfect, handwriting, but I believe you can manage it, right? Fine. Okay, now I'm trying to relate standards also to the same visualization, right? I believe you have a piece of paper in your hand. With me, you can draw this diagram, right? So then you can compare with your own studies. Unmodified opinion means SLAU is 700. That is the standard to address or to talk about, to explain unmodified opinion. When it's come to modified opinion, what is the standard? SLAU is 705. So those two standards we should cover in this session. Not only these two, some more standards. Now we have discussed, or we not discussed, we have identified two auditing standards around this topic. One is relating to unmodified opinion, another one is relating to modified opinion, right? Fine. Let's take unmodified opinion. Unmodified opinion means, how do you deliver this opinion, right? How do you deliver unmodified opinion? So, unmodified opinion, you will say financial statements are present fairly. Financial statements are present fairly, which is unmodified. There is no modification. Or else we can say financial statements are true and fair view. True and fair view. Financial statements are true and fair view. The meaning of this is what? Financial statements are free from material misstatements. But normally in audit report you can see opinion like this. Financial statements are present fairly. Fairly present karla tiyena. Meaning there is no modification. Unmodified opinion, right? This is the way it delivers, right? Fine. For you to deliver unmodified opinion, just you can't say financial statement of this client is present fairly. You have to do some works around this. For you to come up with this opinion, to say financial statements are present fairly, you know, we have to gather sufficient appropriate audit evidence. So then, before that, you have to plan this audit properly. To give unmodified opinion or modified opinion, whatever the opinion, you have to gather sufficient appropriate audit opinion through proper audit planning. Meaning, SLAU is 300 plus 315 plus 330. So all these standards are relating to audit planning. Audit planning, right? Audit planning. So through this planning, you have, when you perform basically audit procedures, right? SLAUS 330 means responding to assess risk. How do you respond to assess risk? By performing further audit procedures. What are the further audit procedures? I'm relating audit planning and risk assessment also to this chapter, right? Risk assessment procedures, sorry. Further audit procedures, test of control, substantive procedures. When you perform test of control and substantive procedures, you will gather sufficient appropriate audit evidence. Sufficient appropriate audit evidence. So all these sufficient appropriate audit evidence, when you evaluate, that is relevant for SLAUS 500 plus series, which we have not yet discussed. We will have another session to discuss this 500 related standard. But all these standard 300, 315, 330, we have gone through in our previous seminar, right? Previous exam focus seminar session, right? Fine. Okay. So once you collect sufficient appropriate audit evidence after you performing test of control substantive procedures, you will gather if there is, I can't say always, right? If there is any material misstatement, the golden word of the auditing, MM. MM is what? Material misstatements, or else let's say misstatement. Forget about the materiality, right? So then standard, another standard says SLAUS 450, very important standard. 450 says you have to evaluate these material misstatements. After you evaluate these material misstatements, you can only say whether financial statements are present fairly. It's a journey, right? When you wake up in the morning, this client's audit report, it's present fairly. No, you can't do it. It's a journey. This is the journey of expressing this unmodified opinion, saying financial statements are present fairly. What is the journey? You have to plan your audit properly. Then you have to follow these key standards starting with 300 plus series. Then when you perform audit procedures, you will gather sufficient appropriate audit evidence that is relating to SLAUS 500 series. Then you will, as outcome of this procedure, you will identify some misstatements. You have to evaluate those misstatements that is relating to SLAUS. That is, how do you evaluate? The guideline is given this standard, SLAUS 450. Then you will decide whether financial statements are materially misstated or not, right? Then only you can say financial statements are present fairly, right? Fine. So let me erase this. Fine, done. Okay, done. Another two standards I'm trying to relate to this before I jump into unmodified opinion. Here, even though you present unmodified opinion, I think you have learned this by now, right? If there is any significant judgment or else significant assumptions or significant risk, you have to address those in audit report. So for that, you have another standard to follow, SLAUS. So let me use a different color for this, right? It's called CAM, sorry, right? CAM, Key Audit Matters, right? Key audit matters addressed in SLAUS 701. What do you mean by key audit matters? I told you, there is no material misstatements in your financial statements that you have audited, but you have identified significant judgment that management has made. Example, let's say when you audit WTC, it's an investment property. So when you value investment property, fair valuation come to the picture. Fair value means it's full with lot of assumptions. Assumptions means management judgment, estimates, right? So those estimates, significant management judgment estimates, you have to address in key audit matter. And if there is significant risk that you have identified, if you can remember our previous session, we explained the meaning of the characteristic of significant risk. What do you mean by significant risk? Significant risk means unusual transactions that required special audit consideration. Unusual non-routine transactions which require special audit consideration. If you identified significant risk during your risk assessment, you have to include in your CAM section. CAM means it's not a modification to audit report. That's why I have taken in that under unmodified opinion. Even though you deliver unmodified opinion, you will include key audit matter paragraph in your audit report. How do you include? Explain in SLAUS 701 that we have to discuss today in our session. Another element of this is emphasis of matter or other matter paragraph. Emphasis of matter or other matter paragraph. This explained in SLAUS 706. Now we have 4 standards: SLAUS 700, 706, 705, 701 and 705. So emphasis of matter and other matter paragraph. Again, when you include emphasis of matter paragraph and other matter paragraph, that is come under unmodified opinion. By including these two, it will not modify your audit opinion. Still, it's unmodified opinion, but you are trying to bring users' attention to this paragraph. Emphasis of matter paragraph means you will bring users' attention to something that you have already explained in your financial statements under notes. So you are bringing users' attention to that particular note. Other matter paragraph means something has not explained in the notes, but still you believe it's required, it's principally required to bring users' attention to that particular matter, fundamental to users' understanding. So then you will include these SLAUS 7, emphasis of matter and other matter paragraph. On top of this, another standard is there, SLAUS 720. 720 also a related standard for audit reporting. Let's say if something is, let's say when you have once you finalize your audit report, you are giving opinion in that audit report based on the numbers in the balance sheet and the P&L. Let's say you have audited P&L and you agree with the given profit or the management profit. But when you compare that with annual report, those audited figures are something not similar or in line with annual report numbers. So then you have to address those non-compliances in your audit report. If there is such non-compliances, you will use this standard to address them. So we'll go through this later, right? Fine. So now how many standards? 5 standards: SLAUS 700, 705, 701, 706 and 720. Other regulatory factors you will include in this section. SLAUS 720 address that. Fine. Then when it's come to modified opinion, auditor will modify opinion because of 2 reasons. One aspect of modification is you have found material misstatements in financial statements. There are material misstatements. Other side of modification is what? Inability to or unable to collect sufficient appropriate audit evidence. auditor has failed or inability to collect sufficient appropriate audit evidence. Under those two circumstances, you will give what more opinion? Modified opinion. Modified opinion. I would like to highlight one more thing here. When it's come to unmodified opinion, for you to deliver unmodified opinion, you must have sufficient appropriate audit evidence. These are some of the tips you should learn, right? Yes, it's required. Even for you to deliver modified opinion under this particular section, what is that? You have material misstatements. You have identified material misstatement. Here also you required sufficient appropriate audit evidence. Yes, it's required. But here, inability to collect sufficient appropriate audit evidence means inability to collect sufficient appropriate. You don't have sufficient appropriate audit evidence. Here, you don't have sufficient appropriate audit evidence. But in these two cases, yes, you have sufficient appropriate audit evidence. So what do you mean by non-compliance, or what do you mean by material misstatements in the financial statement? Here, you will end up with material misstatements in the financial statements due to three reasons, I would say, right? Your standard has properly, your study pack also has properly explained this. Why non-compliance or why material misstatements are available? May be due to accounting standards, your financial reporting related standards are not appropriate. Something wrong with appropriateness of selection of the standard, right? Accounting standard, financial reporting, right? Financial reporting or standards are not appropriate. Appropriateness of financial report standard, appropriateness, let's say appropriateness. Your standards are not appropriate. That's why you have ended up with material misstatements. Or method of application. Method of application. Or presentation and disclosures. What do you mean by these three? So why we have ended up with, or why there are material misstatements? Why? Why material misstatements avila tiyenne? Because of what? Something wrong with the appropriateness of the accounting standards, or something wrong with method of application, something wrong with presentation and disclosures. Because of these three reasons, you have identified material misstatement in your financial statements, right? Misstatement basically. I'll erase the word material because there's a reason for that. I'll explain, right? Materiality should come below, that's why. Misstatements are available. Again, my writings are not that perfect, but I believe you can follow me properly, right? Fine. Misstatements are available. Why misstatements are available? Accounting standards that you have applied is not appropriate, selected is not appropriate, method of application is wrong, application wrong, presentation and disclosure. Appropriateness, revenue recognition is not appropriate. Let's say some of the assets are not depreciated. So then application is not appropriate. Method of application is wrong. Meaning, irrespective of assessing NRV of inventory, you have solely mentioned or solely identified stocks at cost. Non-compliance with LKS2. Method of application is wrong. You have not valued fair investment properties at fair value, then method of application is wrong. Presentation and disclosures. Disclosures are not adequate. Because of that, misstatements are available. These misstatements can be material, right? All these misstatements can be material, or material and pervasive. Material and pervasive, right? Material and pervasive. When it's come to inability to collect sufficient appropriate audit evidence, that is also mainly due to three reasons. I don't have space. I'm trying to summarize with the available space, right? I believe you can follow me properly, right? Misstatement will be there because of these three reasons. Similar to that, you might not be able to collect sufficient appropriate audit evidence because of three reasons. Timing issue, we'll discuss later in detail, right? Audit has appointed after the financial reporting date. Because of that reason, you might not be able to collect, you have not, or you fail to collect sufficient appropriate audit evidence. Another one is beyond the control of entity. Beyond the control. Entity or whoever can't do anything beyond the control of entity. Because of fire, all documents are destroyed. No one is responsible. Fire, it's something, one incident happened in the organization, right? It's beyond the management control, beyond the auditor control, but somehow you have not able to collect sufficient appropriate audit evidence. And third one, management impose limitation. Right? Management enforced limitation. Because of these three reasons, again, you might not be able to collect sufficient appropriate audit evidence. Timing issue, beyond the control of entity, and management enforced limitation. This particular issue also can be, again, material or material and pervasive. Material and pervasive. Material or material and pervasive. Right. If it is material, if something material, right? If something material, then your opinion is qualified opinion, right? Here also it's qualified opinion. Qualified opinion. If non-compliance with accounting standard or misstatements or inability to collect sufficient appropriate audit evidence, if both are material, right? Your opinion, modified opinion will be what? Qualified opinion. Those are technical words. We'll discuss later. Don't worry. I'm summarizing the end-to-end story here. If misstatements if there are misstatements, that is material, not only material, material and pervasive, then the opinion is what? Adverse opinion. If inability to collect sufficient appropriate audit evidence is material and pervasive, then it is disclaimer opinion. Disclaimer opinion. So why I summarize this into one page to explain you or to familiar or to understand whether we are familiar with these keywords. What are the keywords that we have covered here? Modified opinion, unmodified opinion, key audit matters, emphasis of matter, qualified opinion, misstatements, disclaimer opinion, and adverse opinion, right? So those are the keywords that we have identified here, right? So this is the high level summary, but we have to discuss this in detail, right? To understand or before we jump into past paper questions. If we can cover these 5 standards properly during our session today, handling exam question is not a big deal. I can give that assurance to you, right? Fine. Okay. With this, we'll jump into key session today. So why I use this summary, just to make sure that we are familiar with these keywords. This is not the session, but this is the overall all the standards that I'm going to cover today, right? Fine. Okay, let's start with our formal session, right? Fine. Okay. So here, if you look at this diagram, right, audit reporting, I believe you can see this properly, right? Since my handwritings are not that perfect, I thought of having this summary in one document, so then easily you can read and you can have your own notes, right? Fine. But let me take you through this summary again with some more examples, right? In previous session means in that high level summary, I didn't cover this relevant examples, but we'll go through this end-to-end story of audit reporting with examples. Then we will see what we have missed by comparing this with our syllabus, I mean study pack. Then we can go to what? Past paper questions. So that's the plan today, right? Fine. As I explained you earlier, right? These are the key standards that we are going to cover today. SLAUS 700, what is that? Unmodified opinion. SLAUS 701, key audit matter, SLAUS 705, modified opinion, SLAUS 706, emphasis of matter and other matter paragraph. Right, fine. Before we go there, right, what you need to understand is this, right? Another point. Okay, what is this? Fine. Here, this is the overall, or I would say audit universe basically, right? In other words, the entire scope of auditing. Our ultimate objective is what? To deliver an opinion through a report. That is the main topic today also. Audit report. In audit report, you can see an opinion. That opinion is to see whether financial statements are free from material misstatements. Whether financial statements are free from material misstatements. If financial statements are free from material misstatements, meaning you deliver unmodified opinion, saying financial statements are present fairly, right? Financial statements are present fairly. Financial statements are present fairly, meaning financial statements are free from material misstatements. Or in other words, financial statements are true and fair. But answer to this question, whether financial statements are free from material misstatement, if answer is yes, right? If answer is yes, it's unmodified opinion. Whether financial statements are free from material misstatement, yes, unmodified opinion. But whether financial statements are free from material misstatements, answer is no. Right? Answer is no. If answer is no, right, you have to, again, if let's say answer is no, answer is no, right? If answer is no, it will go to modified opinion. SLAUS 705. I can't draw this arrow to other side because then this diagram will be, not qualitative diagram, right? Fine. So this is what you need to understand. If financial statements are free from material misstatement, unmodified opinion. If no, whether financial statements are free from material misstatement, no, then it will go to modified opinion. Who can give this assurance? Who can deliver this opinion? This opinion can be delivered by only an independent party. Independent party, meaning independent auditor. That's why if you look at auditor's report, it says independent auditor's report. You can't just say auditor's report. It should be worded as independent auditor's report. This person who is giving this opinion should be independent. Independent requirements explained in where? Code of ethics, right? Other thing, all this story of auditing is based on what? One framework which is called assurance engagement framework. So all these other element of audit universe is based on the foundation. What is the foundation for auditing then? Assurance engagement. On this foundation, independent auditor is following auditing standards covering planning standards and audit evidence related standard. This is 300 plus series audit planning. Audit evidence 500 plus series audit evidence. By planning and gathering sufficient appropriate audit evidence, you deliver your opinion through a report. Audit report related standards I have listed down here, starting from 7. So 500 series, 700 series and 300 series covers what? All auditing, audit universe, I would say. Here you can see all 300 standard and 500 plus standard. So this is audit universe. Where are we now today? Audit planning discussion. Here we are going to discuss audit planning here. Fine, done. Now with this, after this high level understanding of audit universe, I am trying to take you through the audit report. Like I did previously, audit report consists audit opinion, right? The element of audit report and structure of audit report will try to run through based on time availability. But the key element of audit report is what? The opinion, right? The opinion, audit opinions, there are two types. Now this is the detailed discussion. Unmodified opinion and modified opinion. Unmodified opinion cover from SLAUS 700. Modified opinion covered SLAUS 705. Right? Unmodified opinion, how do you deliver? In your in audit report saying financial statements are present fairly. This is a general term. Or else you can say financial statements are true and fair view, same meaning. Or else you can say financial statements are free from material misstatements, same meaning. But generally in audit report you can say what? You can see what? Saying financial statements are present fairly. To deliver unmodified opinion, for the time being, let's forget about this modified opinion. Let's complete this unmodified opinion. Then we'll jump into modified opinion. I explained to you, you can't say it's unmodified opinion, or you can't deliver unmodified opinion. There's a story behind it. This is the entire story. You have to plan your audit properly before you come up with any kind of audit opinion. Right? SLAUS 330 says response to the assessed risk, right? When you respond to assessed risk using further audit procedures here, further audit procedures, you will collect sufficient appropriate audit evidence, right? For you to collect sufficient appropriate audit evidence, what kind of further audit procedures you should follow? Test of control and substantive procedures. So here you will gather sufficient appropriate audit evidence, right? Here the evidence gathering process and audit planning process basically. Meaning you have to plan your audit properly and you have to gather sufficient appropriate audit evidence. Once you plan your audit properly and once you identify risk, the planning explains what? Planning says explain what? Identify, assess risk of material misstatements. Once you identify risk, respond to the risk, then you will gather sufficient appropriate audit evidence to say whether financial statements are materially misstated. That's the whole story, right? Fine. So then after you collect sufficient appropriate audit evidence about the material misstatements, right? Here, SLAUS 450 or 450 standard asks us to evaluate and see whether uncorrected misstatements are material. Very important word. Uncorrected misstatements are material. What do you mean by that? Are we going to correct all the misstatements that you have identified during planning series or when you plan your audit and when you gather sufficient appropriate audit evidence? No. What we will adjust in the financial statements are material misstatements. If something is material, yes, of course, you will adjust in the financial statement. You will inform management and you will adjust in the financial statements, right? So that's how it's happened. But there are some other standards, some misstatements you will not adjust. What those misstatements are? Uncorrected misstatements. You take the list of uncorrected misstatements which are not material and see all together as a bulk or or cumulative impact of those uncorrected misstatements are material. Example, now let's say, let's say your materiality, overall materiality. Oh, what happened? Sorry. Let me take this to explain that. Right. Let's say your overall materiality, right? There are two materiality, SLAUS 320, explain materiality, right? There are two levels of materiality. Materiality for financial statement as a whole, which is called overall materiality. And performance level materiality. Materiality. So let's say overall materiality is, let's say, 5 million. Remember, this is the level, this is the materiality level you use to evaluate misstatements and to decide whether financial statements are materially misstated. Meaning, this is the material level impact on your opinion, basically. Not this, right? Not the performance level materiality. If anything, any misstatement beyond 5 million has impact on opinion, in other words. I believe you understand it. Let's say your inventory balance is overstated by 6 million. Overstated by 6 million. Yes, it has impact on your opinion. Right? Because it's beyond the overall materiality. But there are certain misstatements, let's say 1 million, 0.5 million, another 0.67 million, right? Another 2 million, and let's say another 0.6 million, plus, so many things, right? So if you take all these together, right, those are uncorrected misstatements. Why? Those are not material, right? Those are not material. But standard wants you to evaluate and see whether cumulative impact of this is beyond overall materiality or beyond the overall materiality. Let's say if the cumulative impact of this is beyond overall materiality, that has impact on audit opinion. You get what I'm saying? So these are uncorrected misstatements. The cumulative impact of uncorrected misstatement, let's say beyond 5 million, which is overall materiality, then it has impact on audit opinion. That's why SLAUS 450 wants you to evaluate whether uncorrected misstatements are material. If uncorrected misstatements are material, then again it will be end up with modified opinion. That's what you need to understand. Then general requirement also you have to follow in giving what? Unmodified opinion. One other. Qualitative aspect of audit. Qualitative aspects means, let's say, when it's come to material uncertainties, estimate uncertainties, you have properly audited those judgments, estimates, right? And reasonableness of estimate. You have audited reasonableness of management estimates, fair value estimates. Overall presentation is in line with required accounting standard, LKS 1, right? And the basis is what? Special purpose or general purpose financial. Special purpose or very important, whether the framework is special purpose framework or general purpose financial statement. What do you mean by this? Let me explain here. Right? So I'll take your study pack to explain this. When you prepare financial statements, let me show you that. Sorry, somewhere here. 1 second. Somewhere down the line. Here, auditors report on general purpose or special purpose financial statements. The guideline on guidelines set out in SLAUS 700 describe above in relation to auditors report on the financial statement with general purpose framework. Meaning there are two frameworks that you can follow in the preparation of financial statements. One is general purpose financial statements. Here, general purpose financial statement. Other one is special purpose financial statement. Here, special purpose. There are two things, general purpose as well as special purpose. General purpose, special purpose. General purpose means, general purpose framework is a financial reporting framework designed to meet the wide range of users, right? So normally when we look at any audit report, normally it's relating to general purpose financial statement to meet a wide range of users. Special purpose financial statement means, now let's say you are going to apply for a bank loan. So significant amount is there in the loan. Loan consideration is significant. So then bank wants you to prepare financial statement based on specific guideline, and bank wants management to audit those financial statements. That is for specific purpose. That is called special purpose financial statements that are subject to audit. General purpose means to meet a wide range of users. Special purpose framework means that is for specific purpose. Let's say IRD. So you prepare financial statement based on tax laws and regulations for IRD. So then it is what? Special purpose. Normal other users, general users, you can't use those financial statements. Let's say bank, for a purpose of bank loan, you prepare financial statement based on the specific guideline. General users, you can't use those financial statements. That is why, that is because of why that is prepared based on specific requirements. So that's the difference between special purpose and general purpose financial statement. So this has been tested in your exam. That's why I wanted to bring your attention to this. Special purpose means to fulfill some specific requirement, right? General purpose means that is to cover the needs of general needs of wide range of users. In general, we prepare financial statement using what? General purpose framework, other than unless if you have a specific requirement. That is also important. Sorry. That is also important to evaluate before you come up with your final opinion, whether financial statements are prepared based on general purpose framework or special purpose framework. If it is special purpose framework, if it is special purpose framework, you have to follow SLAUS 800, not the 700, 800 for special purpose financial statement. When you give opinion on special purpose financial statement, that's SLAUS 800, not 700. So this is the story behind unmodified opinion. In short, what? You have to identify risk and assess risk and response to assess risk using further audit procedures, which is test of control and substantive procedures. Then you have to evaluate whether uncorrected misstatements are material, and you have to evaluate whether these general requirements are satisfied. So then finally you will deliver unmodified opinion. How to deliver unmodified opinion? Let's go through the study pack later, right? Fine. Then when it's come to modified opinion side, right? Modified opinion side, right? Under unmodified opinion, there is another two standard, SLAUS 706, emphasis of matter and other matter paragraph, other matter and key audit matter. Key audit matter. I'll come to that later as a final step. Fine. When it's come to modification, again, you can remember at the start of this session, I told you one aspect of modification is what? Whether financial statements are free from material misstatement. Whether financial statements are free from material misstatements. Right? Auditor has obtained sufficient appropriate audit evidence to conclude that financial statements are not free from material misstatement. Here, in this section, this part, you clearly identified financial statements are not free from material misstatement. If it's free from material misstatement, it will come to other side, unmodified opinion. Why there is modification? Financial statements are not free from material misstatement. Meaning, in layman language, there are non-compliance with accounting policy. Right? If someone asks why why financial statements are not free from material misstatement, meaning there are misstatements. Why there are misstatements? There are non-compliance with accounting policy. So this non-compliance, right? This non-compliance can be, right? This non-compliance can be something wrong with appropriateness. Something wrong with appropriateness. Sorry. Something wrong with appropriateness of accounting policy. What do you mean by something wrong with appropriateness? Here is the example. I told you, I want to discuss some more examples in this discussion, right? Then only you can be familiar with these concepts, these elements, right? Something wrong with appropriateness means some assets of the business are not depreciated. Assets are not depreciated. Fixed asset, you have to depreciate according to LK 16, but you have not depreciated, meaning your accounting policy is not appropriate. Selecting a revenue recognition policy is not in line with SLFRS 15, revenue from contract. You have to follow 5-step model, and finally you have to see whether risk and rewards or control over goods that you have sold has been passed to the buyer, right? You have to follow 5-step model. You have to identify consideration. You have to identify performance obligation. All these 5 steps you have to follow. But revenue recognition is not in line with 5-step model explained in SLFRS 15. Then revenue recognition is not appropriate. Let's say companies identified revenue when you raise invoice from the system, but goods are still in your warehouse, meaning the control over goods you sold has not yet passed to the buyer. If you have not yet passed to your buyer, raising invoice is not the appropriate point you to recognize revenue. Non-compliance with accounting policy, appropriateness. Method of application, you have not applied the standard properly. Example, consistency. Consistency means change in fair value model to cost model. If you take investment property, there are 2 options in LCase 40. What are the 2 options? Either you can measure investment properties as cost, or either you can measure investment properties at fair value. But this year you decided, okay, we'll go ahead with cost model. Next year, previous year it was cost model. This year you decide it should be fair value. And next year again you will move into cost model. Jump in from one model to another model is not appropriate. Is not appropriate. right? It is not consistent. So then something wrong with method of application. Another one, stocks are not valued at lower of cost or NRV. You have ignored net realizable value of stock and you have reported it at cost always. So then method of application is wrong, because standard says clearly what? You have to measure inventories lower of cost or NRV, whichever is lower. But you have not considered that. Something wrong with method of application. And adequacy of presentation, that is the most common example is what? Material uncertainty related to going concern. If there is material uncertainty related to going concern, that is also will be give you some indication about non-compliance with accounting policy. Meaning there are material uncertainties related to going concern, but you have not disclosed in the financial statement, which is fundamental to users' understanding. But you have omitted those disclosures. So then, because of these three reasons, you will be end up with material uncertainties, non-compliance with accounting policy. Now we have to decide this non-compliance is material or beyond the materiality, meaning not only material and pervasive. That is auditor's judgment. There is no hard and fast cutoff to say from this level onwards is material and this level onwards is material and pervasive. It's auditor's judgment based on their experience, skills, expertise, right? Because of any of these reasons, you have ended up with non-compliance with accounting policy, meaning there are misstatements. Now you have to evaluate whether those misstatements are material. Material? How do you define? Material based on what? SLA US 320. 320 explain how to calculate overall material. I told you this opinion is based on what? Overall materiality. Material level for the financial statement as a whole. So if something beyond overall materiality, yes, it is material, but some situations, some cases will be there. It has more pervasive impact, significant impact. So then you can say it's not only material and pervasive, right? How do you define this pervasiveness? We'll discuss later. Later means now itself, right? Fine. Okay. So if it is material, your opinion will be, students, remember, qualified opinion. Your opinion will be qualified opinion. Sorry, I don't know. Okay. Qualified opinion. Always, if something is material, if misstatement is material, your opinion is what? Qualified opinion, right? So in your audit reports, separate paragraph will be there to say qualified opinion. The difference between each of these opinion will go through quickly during our study pack go through session, right? Okay, some people call it as except for opinion or qualified opinion, but generally, I mean, in formal way, in your audit report, we mention it as qualified opinion in your opinion paragraph, right? Fine. Okay. Example, right? So, other thing what you have to remember, when you deliver this opinion in your audit report, remember, you must quantify the impact of the impact. You must, right? You can't just explain the background of the case or modification. You have to quantify the impact. Example here, inventory measured at cost without taking lower of cost or NRV. Simple example, always it's familiar to us, right? What do you mean by that? Let's say your material level is 5 million, right? Your material level is 5 million, but inventories are overstated by 6 million. 6 million. When your overall material is 5 million, your inventories are overstated by 6 million. Why? You have not considered net realizable value. If you have considered net realizable value, inventory should have been written down by 6 million. Since you have not yet calculated or not considered NRV, your stocks are value overstated by 6 million, which is a non-compliance with accounting policy. Why? Something wrong with method of application, and it is beyond the overall materiality for 5 million, then you have to deliver what? Qualified opinion. Qualified opinion. Right? Fine. So that's all about qualification. So when it's come to other side, sorry. If something is material and pervasive, right? If something material and pervasive, let me take this part properly, right? Something material and pervasive, meaning it's beyond the materiality, right? Then your opinion is what? Very important, adverse opinion. If something is material and pervasive, it is adverse opinion. How do you define pervasiveness? Right? You can say something is pervasive to financial statements under these three circumstances. Very, very important for exam. When examiner give you a background to the case, you have to define or you have to conclude basically whether it has pervasive impact or not. When you determine pervasiveness, you have to follow these three guidelines. If something fall under these three, one of these three category, yes, you can say it has pervasive impact. Number one, to define pervasiveness. I believe you are with me. Very, very important, right? Not confined to specific account balance, transaction, or presentation and disclosures. Meaning, not confined. Meaning, many issues are there. What do you mean by that? Let's say, inventories are overstated by 6 million. Yes, it is material. Not only that, some of the assets are not depreciated together with this particular issue. And there are long outstanding receivable, but we have not identified debtors impairment. Now three issues. Assets are not depreciated, inventories are overstated, debtors are not impaired, even though long outstanding debtors are there. Another example, another misstatement. What is that? Let's say investment properties are not measured at fair value. Even though company policy says that investment properties should be measured at fair value. Now 4 issues, meaning many issues, not only one. When there are many issues and each of them are material, then you can say, you can deliver adverse opinion. How do you deliver adverse opinion? What's the difference between adverse opinion and qualified opinion? That's why I didn't explain qualified opinion here, because I wanted to do a comparison. Here, remember, the impact of adverse opinion is very dangerous. How do you deliver adverse opinion? This is the paragraph wording. Your paragraph heading will be adverse opinion, and you will tell because of the significance. This is very important part. You have to mention this. Because of the significance of the issues. What are the significance of the issues? Assets are not depreciated, debtors are not impaired, inventories are overstated, something wrong with fair valuation of investment properties. Because of the significance of the issues, financial statements are not free from material misstatements. In other words, financial statements are not present fairly. Complete opposite of unmodified opinion. Unmodified opinion means what? Financial statements are present fairly. Here, financial statements are not present fairly. Adverse opinion. Right? Why? There are many issues. So what's the difference between adverse opinion and qualified opinion? Here, except for this inventory issue, inventories are overstated, except that issue, except this issue, the rest of the financial statements are present fairly. That's fine. Only problem is what? Inventory. Except inventory, rest of the company financial statements are present fairly. Anit element gan prashna neka api kiyane except for opinion. Except the matter described in basis for qualified opinion paragraph, rest of the company financial statements are present fairly, except this inventory. But here you can't say except. Because of the significance of the issues, financial statements are not present fairly. Kisima samamak naha. Financial statements are not present fairly. Metana, except that particular matter, financial statements are present fairly. That's the difference between qualified opinion and adverse opinion. This is except inventory, rest is okay. Here, we can't say except inventory, except depreciation, except debtors impairment, except fair valuation of investment property. So we can't have 4 exception cases. Because of significance of the issues, financial statements are not present fairly. There are many issues. When you have many issues, yes, the issue is pervasive to the financial statement, significant to the financial statement. The second parameter, second category of pervasiveness definition. Here something is confined. Yeah, tani issue ekai. Ekai issue ekai. Metana many issues. Metana ekai. Confined to one specific account balance, transaction or presentation disclosures. One issue, one non-compliance is there. Only one non-compliance. But the problem is that particular issue is substantial to the financial statement. That one single issue represents substantial portion of the balance sheet of the financial statements. Let's say inventories are not measured at lower of cost or NRV. Instead, they measured only at cost. Inventories are 80% of the total asset, substantial to the balance sheet. 80% of total asset represent inventory, and inventories are not measured at lower of cost or NRV. One single issue has significant impact to the financial statement, confined to account balance that represents substantial portion of balance sheet. Then it has pervasive impact. Third one, disclosure, which is fundamental to users' understanding or users, which is fundamental. Most common example is there are material uncertainties about going concern, but management has not disclosed that in the financial statement. When there are material uncertainties related to going concern, you must disclose those in the financial statement. SLAUS 570 standard. Explain this clearly. When there are material uncertainty related to going concern, you must include that in your financial statement as a disclosure. But these disclosures, which are fundamentally users' understanding, has not been disclosed, that has pervasive impact. Under these 3 circumstances, you will identify pervasiveness to the financial statement. When there is pervasive impact, yes, you will deliver what? Adverse opinion, saying that financial statements are not present fairly. Right? Fine. Here, another example. ABC Limited has another subsidiary, XYZ Limited. Market value of purchase consideration. So the whole idea of this example is here, right? The purchase consideration is 100, fair value of asset and liability is 80, goodwill is 20, but this has not XYZ. So this particular entity has not been considered for what? Consolidation. So then it has pervasive impact. So then you will deliver adverse opinion. So this is there in your study pack as well as an example. Let's discuss there, right? Fine. So now the one part of this modification is completed, over, right? You can modify your opinion because of non-compliance with accounting policy. Non-compliance can be because of these 3 reasons, and the impact can be material and pervasive. If there is pervasive impact, this is the way you define pervasiveness. How do you deliver your opinion? Saying financial statements are not present fairly, but when it's come to material impact, when there is only material impact, the opinion will be except for opinion, meaning except for that particular matter, rest of the company financial statements are present fairly. Right? Fine. Done. Then other side. Right. Scope limitation, meaning inability to collect sufficient appropriate audit evidence. This is the other side of modification. One is non-compliance with accounting policy. Other side is what? Inability to collect sufficient appropriate audit evidence. I told you, auditors are not in a position to collect sufficient appropriate audit evidence because of three reasons. One is beyond the control of management. Fire, backup destroyed. Because of fire, the entity's all records are destroyed. So management can't do anything. Auditor also can't do anything. But documents has been destroyed. Evidence are not there. Scope limited. Inability to collect sufficient appropriate audit evidence. You don't have audit evidence. Other reason is what? Timing issue. Your financial reporting date is 31st March, whereas auditor has appointed 2nd May after almost 1 month's, after 1 month's time, right? Because of this delay of appointing auditors, auditor did not participate, auditor has not participated for stock count, and there is no other mean of collecting sufficient appropriate audit evidence. No stock counting records are available, and previous auditor also has not been participated for stock verification. Because of those reasons, you are not in a position to collect sufficient appropriate audit evidence about existence of inventory as of 31st March. Timing issue. No sufficient appropriate audit evidence. Other one is very interesting. Management enforced limitation. Management enforced limitation means management did not allow, right, to gather sufficient appropriate audit evidence. Example, let's say you are auditing group of company. So group of company means it has subsidiaries, joint ventures, associate. Let's say when you take joint ventures and associate, you take what? Share of profit. Share of profit. When you take share of profit, right, you want, let's say the joint venture share of profit 10 million, right? Sorry, joint venture profit is 10 million and your share of profit is 50% is your share, then 5 million, right? So then when you audit financial statement, you need to audit this 5 million because this 5 million is there in your P&L as share of profit from joint venture. Then you decided, yes, I need to talk to joint ventures auditors to see whether this 5 million has been audited or this 10 million has been audited properly. But management did not allow to reach joint ventures auditors. Management is saying, no auditor, you can't reach joint ventures auditors. You don't have, you should not access. Management imposed limitation. Management put some limitations. Because of that, you might not be able to collect sufficient appropriate audit evidence about this or regarding this 5 million, which is identified as scope limitation. Meaning auditor's scope can be limited because of three reasons: beyond the control of entity, and timing issue, and because of management enforced limitation. Again, the impact can be material like this, scope, like non-compliance with accounting policy, right? Arrows you can see. Something can be material because of non-compliance with accounting policy, as well as something can be material because of the scope limitation. In both cases, if something is material, yes, your opinion is what? Qualified opinion, say under material category, right? This is, if it is something material, something means whether it's scope limitation or non-compliance with accounting policy, if both are material, yes, it's qualified opinion. Here, it's very important. Scope limitation can be material and pervasive, meaning significant impact. Example, let's say inventory represent 80% of the stock, but no one has participated, even previous auditor or management has not conducted physical stock verification to see whether system reported inventories are physically exist. No one has done that verification. No one has conducted that physical stock verification. Since it represents 80% of the balance sheet, it has pervasive impact. How do you define pervasiveness? We went through earlier. Confined to one specific issue, or which is represents significant portion of your balance sheet, and there are many issues. Here, stock verification has not been done, and no evidence, further evidence, no alternative audit evidence to see whether inventories are exist, system reported inventories are exist physically, then impact is material, scope has limited, disclaim opinion. How do you deliver disclaim opinion? Meaning auditor will not deliver an opinion. Auditor is not giving an opinion. Auditor කියන මතයක් දීමෙන් වැළකී ඉන්නවා. Why? For you to deliver an opinion, you must have audit evidence to say whether financial statements are present fairly or not present fairly. You must have audit evidence. But in this case, no evidence. Without evidence, you can't do anything. And the matter is so significant, material and pervasive, then it's disclaim opinion. Right? Not only that, another scenario is there to deliver disclaim opinion. This is really important. I don't know whether students understand or this or not. There is one important part. Disclaim opinion will be given when there are multiple issues. What do you mean by multiple issues? It's like this. Remember, assets are not depreciated. Stocks are overstated. Debtors are not impaired. Fair value estimates are not in line with fair value standard. There are 4 issues relating to non-compliance with accounting policy. On top of that, you have identified something wrong with management integrity and market is not performing well. There are going concern issues. Customers are not paying on time their receivable. Suppliers has filed legal case against the company. Right? And company's market share is now getting down because of competition. Right? Earlier you were the market leader, now it's not the case. You are badly performing in the market. There are some qualitative aspects also, meaning multiple issues are there. Suppliers has taken legal cases against the company because you have not paid. Company cash flows are negative. There are so many non-compliance with accounting policy. Multiple issues. When you have multiple issues, yes, your opinion will be what? Disclaim opinion. Your opinion will be disclaim opinion. Right? Even though you have evidence here, when you have multiple issues, your opinion will be disclaimer. මතයක් දීමේ වැළකී ඉන්නවා. Hey, there are so many issues. So many, multiple issues. Right? Fine. So this is the summary of modified opinion. Right? Summary of modified opinion. Right? SLAUS 705. So here I have covered all the required elements. Right? Now you know what is unmodified opinion, what is adverse opinion, what is qualified opinion, what is disclaim opinion. Right? Fine. Done. Now coming back to unmodified category. Right? Under unmodified category, I would like to bring your attention to these summary notes. Yeah, this summary note. What is that? Key audit matter. Here you have summary. Here you have a summary. Right? What is that summary? First of all, let me explain what is this CAM. Why CAM is important, right? Why this standard introduced to this syllabus, right? Give me a second. Sorry. Why key audit matter section introduced to audit reporting? Okay. If you take 100 companies in Sri Lanka, in how many companies you can see qualified opinion, adverse opinion, undisclaimed opinion? Very few. Very few in the sense, sometimes you will never find. Sometimes yes, but very rare. The meaning of that is the financial statements are perfectly in line with accounting standard? Maybe. Is that the case? Is that the case when you don't find qualified opinion, adverse opinion, or disclaimed opinion, the financial or the entities doing well? May not be the case. There are some issues. But those issues are not enough or not meet the definition of qualification, or those issues not meet the definition of adverse opinion, or those issues not meet the definition of disclaimed opinion. But there are certain problems. What kind of problems? This is the issue. Sorry. So this is the issue. Let me cover that from the key audit matters. These are the issues. Sorry. Key audit matters, those matters that in auditors professional judgment, auditor ke professional judgment taking, right? Auditor ke professional judgment matters here were most significant according to auditor's judgment. Some matters are most significant in the auditor financial statement of current period. The key matters are selected from matters communicate with those charged with governors. Some of the key most significant matters that you have communicate with those charged with governor, basically with audit committee, you will communicate some internal control deficiencies, so many issues. Out of that list, you identified some of the most significant matters from auditor's judgment, and those matters you identify as what? Key audit matters. Key audit matters, right? Key audit matter, the aim, the target, the main objective of key audit matter paragraph in audit report is to improve, remember, transparency by giving or by helping users to understand more significant issues, and this should be enhance the cumulative value of audit report. This will improve value of audit report. There are more significant matters that you have communicated with those charged with governor, and now auditor think it is important for us to include these matters in auditor's report under key audit matter paragraph. That's a separate paragraph. Remember, this is mandatory for listed companies. No option, no choice. Right? No choice. It is mandatory for listed companies. Why? Listed companies are running with general public's money. Therefore, the significant matters you must include in your audit report under CAM. Remember, when you include these significant matters, right? It will not modify your audit report. CAM do not constitute a modification to the report. So SLAUS 701 explain these things. Key audit matters are matters that are more significant to the users. What is more significant? How do you select more significant? The matters that you have explained or communicated with those charged with governor. I'll tell you what matters, right? But when you include these most significant matters in your audit report, that does not modify your audit report. It's not a modification to your audit report, right? Other thing, key audit matters are not substitute. It's not a substitute for disclosure of emphasis of matter or other matter paragraph. Because substitute name emphasis of matter on the other matter paragraph. Right? Then tamadanne mukadda me cam. No, that me cam most significant. The matters which auditor may determine to be cam. Right? What is most significant? These are the most significant matters. May areas to matters anduraganna key audit matters. Monada. High risk areas. High risk, or you can say significant risk. What is significant risk definition? Unusual, non-routine, complex transaction which require special audit consideration. So that's the definition of significant risk according to SLAUS 315. If you can remember our last session, we went through. The significant risk you will include under key audit matter paragraph. Significant judgment in relation to the areas where management made judgment, fair value estimates. So if you take WTC, World Trade Center audit report, the fair value of investment property is subject to a lot of judgment, assumptions. So fair valuation of investment property must be included as key audit matter in WTC audit report. If you take dialogue audit report, revenue recognition is subject to significant judgment, then it must be included as key audit matter in their audit report. Significant risk. Let's say significant risk. Example, one person is managing entire cash management process. So that indicates significant risk. No segregation of duties. You will include under key audit matters. Significant event or transaction occurred during the year. Let's say significant acquisition, group structure change, management change, or disposal of one business unit. Significant event happened during the year. You will identify it as what? Key audit matter. So when you identify significant matters that should be included in key audit matter paragraph, this is the guideline. High risk, significant judgments, significant event or transaction occurred during the year, you will include in key audit matter paragraph. The key part of the definition of CAM above is that these are most significant matters. These are most significant matters in auditor's professional judgment. Remember, before you include anything in CAM, you must have been communicated with those charged with governance. You will pick most significant matters come under this definition from the list that you have communicated with those charged with governance. Right? Fine. Okay, coming back to our diagram. So here, summary is this. This is what we have discussed. Key audit matters. Key audit matters are matters that auditors judgment most significant matters. Reporting can aim to improve transparency. It's mandatory for public listed company. CAM is not a substitute for modification of audit report. Remember, when there is a disclaimer opinion, key audit matter section must not be included in your audit report. The opinion, let's say, disclaim, then key audit matter section must not be included, remember, right? So this is what the definition of or scope of key audit matter: significant risk, significant judgment, and significant event happened during the year. So examples you can see here, right? And CAM is not a considered a modification to audit report, right? Fine. So this is the summary, but I would like to take you through some important points relating to CAM, because students, you have this misunderstanding or complexity. I'm going to clear that misalignment, right? What is that? Have you missed any important thing here? Okay. Okay, when you include CAM in your audit report, these are some of the key important things you must remember when it's come to CAM, right? When you explain any key audit matter in your audit report, this is very important. What? You had to explain why matter was considered to be more significant. You can't just say this is significant. You have to give the background. Why matter was considered to be more significant in your audit and therefore determined to be key audit matter. This has to be description. You have to describe why matter is significant. Not only that, how matter was addressed in the audit. If it is more significant, what you have done to address that risk, to address that point, what auditor has done. Normally in audit report, there are two columns. One is to describe why it is most significant, and other column is to address how, to explain how auditor has addressed that particular key audit matter. So this is important. If you take any audit report, you better download Dialog Audit Report. It has a table. In that left column, you explain why matter is most significant and how auditor has addressed that point in their audit, right? Fine. So that is important. These are key things that you remember relating to key audit matter, right? So you know key audit matter example here. You can read it, right? I'm not going to because of the time constraint, right? Fine. Key audit matter has been explained here. Right? If you look at, you can see revenue recognition. Why revenue recognition is significant and how audit here. Our audit procedures. This is important. Let me take you through this. Right? So I told you, when you explain CAM in your audit report, this is the way you explain. This paragraph explains why it is significant. Here, the amount of revenue and profit recognized in the year on the sale, right, and aftermarket services is depends on the appropriate assessment whether or not each long-term aftermarket contract for services is linked to separate contract for sale of, right? As the commercial arrangement can be complex, significant judgment is applied in selecting accounting basis. In each case, in our view, revenue recognition is significant to our audit. Because of this reason, they believe revenue recognition is significant matter, right? As a group might inappropriately account for sale of long-term service agreement as a single arrangement for accounting purpose. And this would be usually lead to revenue and profit being recognized too early because the margin in long-term service agreement is usually higher than margin margin in the sales arrangement. This is the context. This is the background. This explains why the matter is significant, right? Then other one, they have to explain how they have addressed this risk in their audit. Our audit procedures are here: address the risk of material misstatement in relation to the revenue recognition, which was considered to be significant risk. Include test of control. We have done test of control, and we have done detailed analysis of revenue, right? This is how they have addressed. Fine. That's why I took that, I explained that. Remember, two things you have to explain. One is you have to describe why it is significant and how you have addressed that particular point in your audit. Relationship with audit opinion. How CAM relate with opinion? Read this. The CAM are key matters for the audit of whole financial statement. They are not a separate opinion. Remember, there are no separate opinion for key audit matters. Normally, auditor is not giving separate opinion on key audit matters. Only one opinion about the whole financial statement, saying financial statements are present fairly or not, right? But we don't give separate opinion on key audit matters, right? That's the relationship between with the audit opinion. Remember, no separate opinion for key audit matters. Another relationship you need to understand, you can read the rest of the things, but I have taken you through only the here. Likewise, the auditor's opinion refers to the financial statement as a whole, right? As a whole, they might give true and for opinion or not, right? Fine. Then, modified opinion. If modified opinion is expressed, key audit matter and modified opinion. That's the relationship I am going to explain. If modified opinion is expressed, now you know what is modified opinion. The matter gives rise to modified opinion. The matter that gives rise to modified opinion. Let's say inventories are overstated by 6 million, which is beyond the materiality. That is the reason for us to give modified opinion. That's the matter. Inventory is the matter. Will be described in basis for modified opinion. When we go through audit report, I'll tell you, since this is exam focus revision session, I believe you have this idea, basis for modified opinion. I believe by now you have gone through audit report format. Therefore, we can't, I told you we can't cover each and every aspect of your audit report, right? And all areas you might not be able to cover this in limited time. When I say basis for modified opinion, you must understand. So this inventory misstatement, you have explained in basis for modified opinion paragraph, and because of that, you have modified your opinion, and opinion has been given in modified opinion paragraph. So it must not be included as a CAM. So again, that particular inventory overstated matter, you cannot include as a key audit matter. If you have modified opinion because of some reason, that particular reason again you can't include where in key audit matter paragraph. That's what it says. Very clear. The auditor shall not communicate the matter in key audit matter section of the auditor's report when auditor would require to modify opinion in accordance with SLAUS 705. That's what I explained. This is important. When there is a disclaim opinion, now I'm jumping into disclaim opinion, which is also modified opinion, right? There are three modifications. What are they? Adverse opinion, modified opinion, disclaim opinion. This is also one modification. Even though this is a modification, when it's a disclaim opinion, key audit matter, CAM section, must not be included in your audit report. You should not include in your audit report. Very important. What is next? SLAUS 701, key audit matter, makes also a special mention. Special mention. These are important things you need to understand. Special mention. Special mention, right? Special mention of going concern. Going concern problem, which have covered previously, right? We have not covered, but study pack has covered. Where there is material uncertainty relating to going concern. If there is material uncertainty relating to going concern, this described in a material uncertainty relating to going concern. It's a separate paragraph in your audit report, right? When you go through audit elements of audit report, I'm not trying to do it today because it's very straightforward. You must go through it. You should have been going through right now. When there is material uncertainty related going concern in your audit report, there is separate paragraph for that. Separate section called material uncertainty related going concern. Therefore, going concern issue should not be included as a CAM, right? It can't be key audit matter, although CAM section will include a reference to material answer related going concern. In CAM section, you can make reference to material answer related going concern section, but you can't describe going concern matters in key audit matter paragraph, right? That's a relationship between CAM and opinion. Now, when it's come to relationship between CAM and emphasis of matter and other matter paragraph. Relationship between CAM and emphasis of matter and other matter paragraph. We haven't gone through emphasis of matter and other matter paragraph yet. But let me explain emphasis of matter at a glance now, since we have to go through this section. Emphasis of matter means something has disclosed in the financial statement. Let's say there was a fire during the year, and that fire has been explained in a note. Now you think it's important to bring users' attention for that particular incident that is explained in note X in the financial statement. To bring users' attention to that particular note X, note number is the X, right? X, you include this emphasis of meta paragraph. You emphasize that particular incident in your audit report. For that, you will use separate paragraph. Other meta paragraph also similar to that. But to include other meta paragraph, the difference between other meta paragraph and emphasis of meta paragraph is this. Emphasis of matter you will use to bring users' attention to something that has been explained under notes in the financial statement. But other matter that has not been included in the notes in the financial statement. Examples I will take you through. But remember, there are two paragraphs in audit report, emphasis of matter and other matter paragraph, as and when it's required, auditor will include. But remember, right, how do we make a relation? How do we segregate this emphasis of matter paragraph and other matter paragraph from key audit matter paragraph? There are potential, some degree of overlap between the matters which could be disclosed as CAM or emphasis of matter. CAM or emphasis of matter. Some degree of overlap is there. Where SLAUS 70 applies, SLAUS 706 state emphasis of matter and other matter paragraph explained in SLAUS 706. When 701 applies, 706 state that use of emphasis of matter is not a substitute for a description of individual key audit matter. Key audit matter paragraph is not a substitute for emphasis of matter and other paragraph. ආදේශකයක් නොවේ. In other words, matter means the definition of CAM should be it should be disclosed as such. In other words, if the matter meet the definition of CAM, yes, you must include it as a CAM, no doubt. Where CAM is also judged to be fundamental to users' understanding of the financial statement, auditor may wish to highlight its relative importance. This could be done, for an example, by presenting a matter in the first in CAM section. If matter is not determined to be CAM but fundamental to users' understanding, then auditor wish to include it under emphasis of matter paragraph. Emphasis of matter paragraph, why do we include? To bring users' attention to something explained in audited financial statement, you think that it is fundamental to users' understanding. But if auditor thinks that is very important to include it under key audit matter, yes, you can include under key audit matter. But you can't repeat it under emphasis of matter again. If it meets the definition of CAM, you can include it there. But if you think it is not that important to bring that point to key audit matter paragraph, but still it is important to bring users' attention, then we can include that particular incident under emphasis of matter paragraph. Similar principle is applied for other matter paragraph as well. What you need to understand basically here, emphasis of matter paragraph is not a substitute for key audit matter. Now we'll take emphasis of matter and other matter paragraph in auditor's report. SLAUS 706 basically. Here 706 revision. Why this revision came? Because of CAM, right? Fine. So let's go through this here. Emphasis of matter paragraph or other matter paragraph in independent auditor's report provide auditors to include this auditors to inclusion of the paragraph in auditor's report either to draw attention that is such importance that it is fundamental to users' understanding. If something is fundamental to users' understanding, you will include that as a emphasis of matter paragraph or other matter paragraph, right? Okay. What is the difference between these two? That is also important to understand. Emphasis of matter is a paragraph included in auditor's report that refers to a matter appropriately presented or disclosed in the financial statement. To include anything under emphasis of matter paragraph to bring users understanding why it is fundamental to users understanding, it must be disclosed in the financial statement. That's the difference between emphasis of matter and other matter paragraph. Other matter paragraph you will include when something has not disclosed in the financial statement, but still you believe it is important for users understanding, right? Fine. Examples. Here, where key audit matter section and emphasis of matter paragraph can come either before or after CAM depending on the significance of the disclosure, right? That's fine. That's something you need to understand. How do we, these are the examples, right? Example of situations in which auditor might include emphasis of matter paragraph. Here, uncertainty relating to future outcome of pending litigations. Pending litigation is there against the company. Let's say supplier has filed a case against the company. You have disclosed that in the financial statement. You believe that it is important to bring users' attention to that particular note in the financial statement. Then you can include it under key audit matter section. A significant subsequent event which occurs between the date of financial statement and audit report, meaning subsequent events occurred. Subsequent event occurred, LKS 10, right? Event after balance sheet date. So that has been explained or disclosed in the financial statement, but you think it is important to bring users' attention. Let's say fire, right? Fire, event after balance sheet. Early adoption of accounting standard, major catastrophes like fire, flood occurred during the financial statement, but that should have been explained in the financial statement. Okay, so this is the wording of audit report. Emphasis of matter. This is important, right? There are two things that you must understand when it comes to audit report paragraph. We draw to attention note text. I told you that must be explained in audit report. That's why you bring attention to note text in the financial statement, which describe the effect of the fire in the company's production facility. Remember, including emphasis of matter is not a modification that you must mention. Our opinion is not modified in respect of this matter. That is one thing you need to understand. Including CAM is not a modification to audit report. Other matter also very much similar to that, but I explain you the difference, right? Other matter paragraph is a paragraph included in audit report, refers to other than those presented or disclosed in the financial statement. Something has not explained or disclosed in the financial statement, but you think that it is important to bring users' attention. These are the examples here. Auditor unable to withdraw from the engagement because of the legal regulatory issues. You can't withdraw from the engagement. If there is such circumstances, you will include that in other matter paragraph. Auditor has been requested report on other matter to provide more clarification in line with legal jurisdictions of the country. So if there is request from legal jurisdictions to report something, that we will be included in other matter paragraph. So this is the content. So this is one example. Here, other matter. The financial statement of ABC company for the year ended 31st March, whatever the year, were audited by another auditor who expressed unmodified opinion. The last year financial statement audited by different auditor, right? And he has expressed or given unmodified opinion on the financial statement. So this has not been explained in a note, but it's something that you believe it is important or fundamental to users' understanding. So then you bring users' attention to this through other matter paragraph, right? Fine. And again, including other matter paragraph is not a modification to audit report. Fine. So then modified opinion, I think we went through this properly, therefore I'm not trying to touch this again and again, right? Qualified opinion, adverse opinion, disclaim opinion. So these are the three types of modification. So pervasiveness, I explained you. What is pervasive, right? And qualified opinion circumstances also I explained in my diagram. Beyond the control of, this is scope limitation. Then adverse opinion also I explained. Disclaim opinion also we went through. Then impact to audit reporting. So these examples. So this is little important, therefore let's go through this quickly, right? Qualified, these are examples. I'll take one or two audit reports to explain this, the differences. I mean, important things I have highlighted here. Let's say it's a qualified opinion due to material misstatement. You can remember qualified opinion can be given because of two reasons. One is material misstatement, which is material, and scope limitation also material. When both are material, you can give qualified opinion. Remember, these are the differences highlighted in yellow. Opinion heading should be named as qualified. If it is unmodified opinion, it's just opinion. If it is qualified opinion, you have to name title heading of this section as what? Qualified opinion. Then you have to mention we have audited of this company's financial statement. Then opinion, in opinion paragraph here, except for the effect of the matters described in basis for opinion paragraph, accompanying financial statements are present fairly, except for opinion. This is what I want to highlight here, right? And basis for, I'm not trying to take you through the case because you can read at home, it's time consuming. Otherwise, I might not be able to cover the scope of the session today. Then when it's come to basis for opinion paragraph, if it is unmodified opinion, we just say basis for opinion. If it is qualified opinion, you have to mention it as what? Qualified opinion, right? Basis for qualified opinion. Here, remember, you have to explain the basis as well as you have to quantify the impact. Here, this is inventory overstatement, right? So this is how they have quantified. The company record indicate that management state that inventory at lower of cost or NRV, an amount of this would have been required to written off inventories down their net realizable value. Accordingly, cost of sale would have been increased by this amount. Income tax and net income of shareholders' equity would have been reduced by this amount respectively. The financial impact you have to quantify in this basis for qualified opinion paragraph. Remember, that is important. Then rest is fine. Second example, adverse opinion. Adverse opinion always you give when material misstatements are there and the impact is pervasive, right? Remember the differences. Here, opinion heading should be, opinion heading should be adverse opinion. The word adverse should bring here, and we have audited, you have to mention that as well. And here opinion paragraph, not except for opinion. Because of the significance of the matter described, it can be many issues, due to many issues, or confined to one issue and it is substantial, or main disclosure, which is fundamental users, has not been disclosed priorly. So those are the definition of pervasiveness. Because of the significance of the matters described, the financial statement do not present fairly or do not give true and fair view, right? Those are the differences. And basis for it must be saying adverse opinion. Basis for adverse opinion opinion. Here again you have to quantify the impact. Here many elements of the company in consolidated financial statement would have been materially affected. The effect of the consolidated financial statement failed to consolidate have not been determined. The financial impact we have not yet determined. That's how you explain, right? That is adverse opinion. Then third one, again qualified opinion under scope limitation, right? Scope limitation. Because of audit inability to collect sufficient appropriate audit evidence. Again same, the audit opinion heading should be qualified opinion. You have to say we have audited and except for opinion, rest of the financial statements are present fairly. You have to say except, and basis for qualified opinion paragraph should be included this word qualified, right? Sorry. I am trying to bring your attention to very important point, that is disclaim opinion. Remember the differences. Here disclaim opinion can be given because of scope limitation or because of multiple issues. I told you disclaim opinion can be given in two scenarios. Scope limitation is material and pervasive, as well as there are multiple issues. When you have multiple issues, also disclaim opinion. Here, in all other cases, you can see, you have seen, I believe, opinion should be disclaim opinion. It is obvious. We have audited. Here, you can't say audited because you are not giving an opinion. We were engaged to audit. You can't say we have audited. If you have audited, you must give opinion. Since you are not giving an opinion in disclaimer, you just say we have engaged. We were engaged to audit. You are not saying we don't say we have audited. In all other cases, if you look at it, the paragraph starts saying that we have audited. Here we do not express an opinion, right? Because of the significance of these matters, right? We have not been able to obtain sufficient appropriate audit evidence. So these are the key factors that you must remember in audit reporting, right? Fine. Then basis for disclaim opinion paragraph, you have to explain we were not appointed as auditors before this stock count, so blah blah blah, right? Fine, done. So we have covered SLAUS 705, key audit matters, this emphasis of matter, everything we have covered. Then let me take communication with those charged with governance. So this is also little important. SLA 705 state that these are things that students should not give their focus, but important. State that auditor expect to express modified opinion. The auditor must, before you include this modification in your audit report, must communicate with those charged with governor the circumstances leading to expect the modification and propose wording of the modification of the audit report. You can't just include as you wish. You have to present, you have to share management, those charged with governor. This is the wording of modification. What do you think, right? This allows auditors to notice those charged with governor, intended modification, and the reason for to seek agreement or confirm disagreement. You take the agreement or confirm the disagreement. If they don't agree, fine, they confirm it. Those charged with governor to modification and give those charged with governor opportunity to provide further information explanations. It's an opportunity for those charged with governor to give more explanation, more information. So this is the summary. You can go through it. Qualified opinion, adverse opinion, and disclaimer opinion. The last part, SLAUS 720. Yeah, other information in document containing auditor's report. Other information, SLAUS 720. The last auditing standard, right? This says what? Other information. What do you mean by other information? Here, other information is financial or non-financial information, right? Other than financial statement audit report. Financial or non-financial information other than balance sheet, P&L and audit report included in entity's annual report. If you take annual report, you can see in annual report you have overview of the overview strategy of the company, financial highlight, planned capital expenditure, financial ratios, explanations, circumstances about accounting estimate. So these are the information other than financial statement and audit report. So if you look at annual report, these can be seen. Annual report is that, right? A misstatement of other, what is mean by misstatement when it's come to other information? Other informations are these: financial highlight, planned capital expenditure, they are overall future strategy, something like that. Exists when other information is incorrectly stated, otherwise misleading, right? Misleading, including because of the omit or information. All right, fine. Misleading. Example. Now let's say in financial highlight, right? In financial highlight, example, financial highlight, right? Financial highlight, they mention profit after tax as 10 million. Whereas in audit report or financial statement, not audit report, sorry, audit report you don't see profit, no, right? Financial statement P&L, it says it's 9 million. Now in financial summaries highlights, it says 10 million, whereas in your audited financial statement, it says 9 million. Now there is a misstatement or misalignment, misleading users because two figures are there. Then this paragraph will clarify that issue. This paragraph is to clarify those non-compliances, right? Here, SLAUS 720 states that auditor shall read other information there in annual report and identify those inconsistencies, and if there are misstatements, you will address that through this other information paragraph in auditor's report, right? Here, if financial statements are materially misstated but management refused to correct, this issue management refused to correct, right? They don't agree to correct this as 9 million, then you will modify opinion, right? Simple. If you highlight this, look here, management, in financial statement profit is 9 million, but in your financial highlight in annual report is 10 million. Please go and correct it. Management refuse, then you modify opinion, right? Modify opinion. If other information materially misstated need to be revised, but management refuse, right? If refuse, Then auditor communicates those charges governor, or maybe you can modify audit report here, include implication in audit report, meaning modify, or you withdraw from the engagement, right? Those actions, those options you have. Normally in audit report, how do you report? So this is the wording. Other information. Management is responsible for other information. You have to tell that. Management, we are not responsible for annual report. It's management responsibility. Management is responsible for other information. Other information comprise information included in the X report, does not include financial statement auditor's report. Our opinion on the financial statement does not cover the information. So our opinion is not to address annual report highlights or whatever things there in annual report. Therefore, we do not express an assurance on other information. This has to be included in your auditor's report. That's all. Done. Sorry. So other information section plays immediately after the basis for opinion paragraph, right? Fine. Yeah, that's all. That's all about the audit reporting. I would like to bring your attention to one part of this before we move into past paper questions. I think all of these we have gone through, study pack, right? Detailed discussion here. So I request you to take a look at on this, right? At home, later. The element of audit report, title, address, opinion section at the top, and basis for opinion paragraph, thereafter going concern issues, key audit matters, and other information, responsibilities of management, responsibilities of auditors. This is SLAUS 720. 720, right? Other reporting responsibilities. Sorry, not that. Sorry. Other information here, SLAUS 720. 720 is come here, right? So you can go through this at home. Yeah, so other than that, everything we have covered, right? All these things we covered. So fine, now you can go to where the recent past paper question number 7. Take that. So with that, we can wrap up. So hurry. Question number 7. Question number 7, part B. Part B. Hold on. Right. Part B. For 10 marks. Now let's see whether we can answer this question. If we can answer this question, yes, we have done a good job. That's what our assessment is, right? Fine. Assess whether you agree with audit team members' statement regarding KAM, key audit matter, 7 marks. Outline the procedures that auditor should perform and report in the auditor's report in respect of KAM identified in B above, meaning here, right? So what they are talking about, KAM. Auditor's risk assessment revealed following. I would like to bring risk assessment, meaning SLAUS 315, risk assessment, by performing risk assessment procedures. Finished good as at 31st March 2024 amounting to rupees 345 million. This was 40% increase compared to previous year. The management has made an assessment on the net realizable value as its face an issue with selling price due to market competition. Because of the selling price, face issues with the selling price because of the market competition, they have done a net realizable value assessment. The detailed assessment on this includes judgment made. Judgment made. CAM definition I'm trying to take you through now. CAM here. CAM. Get things that we have discussed. CAM එකක් වෙන්නේ මොකද්ද? Significant judgment. They have made judgment. Judgment made in deriving NRV adjustment of 105 million. 105 million was made available, a provision of 85 million made available. So they have adjusted 105 million. A provision of 85 million has been made on the raw material balance at the balance sheet date, right? Fine. So the question is what? The question is, if I go to requirement, assess. You have to assess whether you agree with the audit team member's statement regarding the CAM. Audit team member statement here. What is their statement? A member of audit team state that above points will be key audit matter in the auditor's report for the year ended 31st March 2024 as the above amounts are material. Right? Fine. අපිට audit member කියන එක වැඩක් නැහැ. We have a definition about CAM. What is CAM? Most significant matters, meaning high risk, significant judgment, significant event. If you look at this, it's a significant judgment. Right? That is your assessment. That's how you have to assess. Since this NRV valuation includes significant judgment, right? Significant judgment, it should be concluded as CAM. Yes, you agree with the audit team member's statement, making this as a CAM. Then CAM එකක් දාන්න නිකම් බෑ. You have to explain why it's CAM. Because you have to assess. That's what you have to explain. Since entity has faced issues with selling price due to market competition, they have made significant adjustment as NRV adjustment to the financial statement based on their judgment. Since this is significant judgment, we conclude this as a CAM. Not only that, second thing, if you can remember, CAM says when you include a CAM, you have to include a paragraph, right, saying that why it is CAM. Right? Sorry, how do you address that? You can remember. You should be able to remember. Sorry, I don't know why it's not. Here, how the matter was addressed. How the matter was addressed, you have to explain. That's the answer for second part of the question. Here, outline a procedure that auditor should be perform and report in auditor's report. They have tested this part of the study pack, right? This part of the part A is that this is part A, this is part B of the question. How you are addressing this point? How do you address this? How do you address this particular issue in auditors? Audit, you write some audit procedures. Sorry. Second, you have to write some audit procedures. How do you address this? You check the reasonableness of judgment when accounting estimates are there, because NRV is estimate. Estimates are subject to assumptions. You check the reasonableness of the assumptions. Reasonableness of the one adjustment you have to write, and you can There's a calculation behind this. You can recalculate and see whether this NRV adjustment is correct or wrong. So those are the things that you can do, right, in here as audit procedures. Second point, sorry, always I do this mistake, right. Second point, Neon, that should be the company name, Neon has recognized deferred tax asset of 15 million as at 31st March 2024 on tax losses. Is it a CAM? But member of this audit team says that is a CAM. 15 million deferred tax asset is a CAM. Again, I'm going to my definition. They are in the study pack. CAM means significant high risk. Deferred tax calculation is not a significant risk. You have numbers, you have balance sheet, P&L to calculate it. It does not include significant judgment. It does not a significant event happen during the year. So it does not mean the definition of CAM. Therefore, this should not be included as a CAM in your audit report. Right? It's very simple. If you are thorough with, or if you stick to the definition, it is very simple for you to conclude whether it's a CAM or not. So here it's not a CAM, right? Third point, Neon carried out an impairment assessment on property, plant and equipment due to current business performance. They have done an impairment testing. An assessment was done by accountant and assumptions used for assessment were approved by audit committee. It was concluded that assets were not impaired as at 31st March 2024. Impairment. Impairment definition, if you look at, right? Impairment. Right? Impairment standard says LKS 36. Recoverable amount versus carrying amount. Carrying amount is higher than recoverable amounts, then impairment loss is there. Carrying amount means cost minus accumulated depreciation. Recoverable amount means fair value less cost of selling and value in use. Fair value means fair value means judgment, estimate. Value in use means present value of future cash flows, discount in cash flows. Discount factor itself a judgment, estimates. Future cash flows, estimates. So this impairment calculation is subject to judgment and estimates. It's subject to judgment and estimate. If something is subject to judgment and estimates, it is what? Meet the definition of CAM. Therefore, this should be included as a CAM. How do you assess that? Since impairment testing is subject to estimates and judgment in calculating fair value and value in use, it should be concluded as what? Key audit matter in your audit report, right? In your audit report. So then you have to conclude it as a CAM. Right? It should be a CAM. So then answer is part B of this one. One audit procedure. You check the reasonableness of future cash flows. They have considered in value in use estimate, and reevaluate the basis or check the reasonableness of fair value estimates, and you can check the discounting factor, reasonableness of discounting factor, and you can do recalculation of impairment if required, right? Third point, that's how you address this point, audit procedures. Fourth point, The actuary who has involved with a company for 3 years issued a report on valuation of retirement benefit obligation as at 31st March 2024. The valuation involves certain assumptions in determining value of retirement benefit. According to past experience, based on past experience, there had been no misstatement noted. Balance as at 31st March 2024 is 86 million. So here, two things. It's subject to assumptions, yes, but calculating retirement benefit obligation is not that complex. Why I'm saying like that? Because last 3 years there is no misstatement they have noted. Even though, you know, when you calculate actuarial valuation, the expected mortality rate and turnover rate and salary increment rate, all these things are judgment estimate. But those judgment estimates are not that complex. Salary increment rate, mortality rate, turnover rate, those are judgment, but those are not that significant. Because of that, I don't think personally this should be included as a CAM. Why? Someone can argue, yes, it has judgment. Yes, of course. It includes judgment. I agree. But remember, is it a significant judgment? May not. May not. Right? That depends on the company nature. But for me to say it's not significant, there are evidence in this case. Here, the past experience, audit experience, there had been no misstatement, meaning this retirement benefit calculation is not that complex, even though judgments are there. Don't make a mistake here. Students understand this, identify, there are assumptions, there are judgment. When there are judgment, yes, of course it's scam. No. Wrong. It should be significant judgment. But in this case, even though judgments are there, those are not that significant. Therefore, it should not be concluded as CAM in my opinion. Right? Fine. So that's how you answer to this question. So we have covered all the relevant auditing standards related to audit reporting, and we did this past paper question. So when we do this past paper question, we realize that the things that we have learned, this study pack can be directly applied. So all these highlighted points, all these areas that I have discussed in study pack, I recommend you to go through again and prepare your own notes prior to the exam and handle this question very carefully. I believe we have done fair job here. This will be useful for you to manage your exam question related to audit reporting. So this is the end of that. We will meet with another revision session maybe next week. Thank you.